Good afternoon, everybody, and welcome to the weekly Fintech Nexus news show. My name is Peter Renton, chairman and co-founder of Fintech Nexus, and joined, as always, by my good friend and colleague, Todd Anderson. How are you doing, Todd?
Good, Peter. How are you?
Doing great. And joining us at the last minute, we appreciate you jumping in, Kevin, with very little notice today after we had a cancellation. So, Kevin, welcome.
It's great to be here.
All right. Well, let's get right into it because lots of news happening this week. And of course, we have to lead off with the crypto news with Coinbase laying off 1,100 people, which is 18% of their staff. It was done in an interesting way, not quite as impersonal as the Better.com layoffs, but done with emails that were sent either to your work address if you were staying, if you were leaving, it went to your personal email. And everyone found out, and you were cut off. If you sort of had pending things were happening in your inbox, whatever, too bad, you're a cut off. But 14 weeks severance pay minimum given to Coinbase. So, you know what? They've tried to do the right thing. I've liked Brian Armstrong, CEO there and founder. He does try to do the right thing. And reality is, he said, we hired too fast. We weren't expecting quite such a downturn. What are your thoughts, guys?
I think that's the last piece is clearly many of these firms and the capital that went into them, kind of forced them to hire very fast in many ways because they need to spend investor capital. Not necessarily maybe as fast as some companies did, but the idea of getting investor capital is to do certain things with it after you've raised the money. But I think overall it's a cautionary tale for crypto. I think the more interesting question really is we've seen the crypto winters come and then go, and then there's a boom after them. Does this change the behavior on the other side? Like, do you see companies begin to be a little bit more conservative, even if maybe volumes go back to crazy levels? Do they just not hire to catch up with those volumes? It seems like there's been a handful of companies in the space who've done that already. Like the Krakens of the world who are still hiring today. But overall, I mean, in a downturn, people lose their jobs. This is kind of how the markets work. And, I think with crypto, it's been kind of this volatility, up, down, up, down, up, down. But it's not surprising when you start getting into the phase of the economy that we're currently entering.
Yep.
Yeah, absolutely. I think I've always loved Coinbase and Armstrong, and I think it shows the ones that aren't. There's a couple companies that are laying off a bunch of people: BlockFi, Gemini, Robinhood, Klarna, even ones that aren't directly related to crypto, but they're all sort of in that same fintech, brave new world companies. And I think it shows a lot of discipline when you grow slowly. And I think that's probably, I can't even imagine, one of the most difficult parts of starting your own company, especially in the tech space. They have huge funding rounds that they have to spend, and it's probably easy to say, well, we're going to hire 4 times more people. And then suddenly Bitcoin drops or wavers around 25K. And what are you supposed to do? A lot of your income comes from selling this stuff, and no one's buying it.
Yep. Yeah. And I read some things this week. I can't remember which company it was, whether it was Binance or one of them was saying that they had a lot of pressure to grow fast. Their VCs, the funders wanted them to grow faster, wanted to add more people. And, they didn't grow as fast as what they could have done. And so there are certainly those companies that have taken a more conservative approach, and those are the ones that seem to be still hiring. But
I mean, how many times did we have the conversation in the last year? Can this company catch up to the valuation they were just given?
Right.
And now we're seeing like a lot, the companies can't catch up, and the market turns so quickly that now they have to cut back on what they started ramping up on.
Yep. Indeed. Okay, well, let's move on with another specific story, which is a negative story in crypto, and that is Celsius. And Celsius are, they've been a crypto lender for a while. We've had the CEO speak several times, most recently just 3 weeks ago at our event in New York before all this went down. But I'm reading a bit more about the Celsius thing. The Wall Street Journal had an interesting article. I think it was today or yesterday. And
today.
Yeah, they've played like they had a $470 million investment in Lido. There's been margin calls happening. I mean, there's been a lot of people that have got significant money at this sitting at Celsius. It was earning a great return, but now is stuck there. And it's quite the big question is, can they remain a growing concern? Well, Kevin, I'd like to hand to you because I know you've just written a piece about this. And what are your thoughts on Celsius?
Well, I've heard of them before as regulators were scared of them because of their advertising, their possible securities or the return they were saying. But after hearing the CEO at our event, we were supposed to actually have an interview yesterday to talk about his perspective because he has this serial entrepreneur, like electric, let's change the whole world mindset. Let's become a bank, but pay out what the banks make on your deposits to the people depositing. That sounds all well and good until your bets start going bad. Like even if in the perfect world, your returns are great, you're getting paid out, you live in this new decentralized DAO hybrid world of DeFi that he was promising. If a couple of your DeFi accounts get hacked, if you lose millions of dollars, if say Tether pulls their $1 billion loan, which they said they did yesterday, then suddenly where do you have even the cash to pay your creditors, let alone the people who have deposited money and locked it in on your account? It's scary and it's sad. And I hope there's talk of them restructuring. They hired bankruptcy or restructuring lawyers. It's a frightening time to be a creator, even if you're passionate and brave in this industry. If they cited themselves, and it's not entirely untrue, there's problems with scams and DeFi bubbles, and even institutions get caught up in them, even if they don't have, I don't know. It's nuts.
Mm-hmm. This one might have a bit more far-reaching impact than the previous story, which was very much about growing too fast and hiring, which happens in a lot of industries, and legislators and regulators kind of are used to that in many ways. But this one could be tricky for the DeFi space, and how the different intricacies of the players and the companies involved and where the money goes and the percentages that you're promising. And the regulators are going to look at this. And there was, in that story, Peter, there was, what was it, 2 or 3 people that went on the record saying I had 60% of my retirement savings in there. Somebody else had $100,000 from I think his wife had passed away, and he was going to use this for an eventual house with his kids, and now that's locked up. And so the more stories you hear like that, the worse it will get for DeFi and companies like Celsius, because that's what the regulators are going to hold on.
Yep.
Unfortunately, because in every industry, there's scams, there's people that are promising too much. But when you're new, the bar is raised. And if you can't hit that bar, it's going to then cascade down to other players in the industry. So I think the Celsius story might be playing out for a while, and it might end up being an example that leads to overregulation. Yeah,
I mean, it's who knows what the regulators will do. But I mean, I'm sorry, but anyone who puts anything more than just a small amount, I mean, it just goes to show how little the average investor knows about the basic principles of investing, and that is don't put anything that you can't afford to lose into a speculative investment. And
you always hear the best investors, the Dalios, the Chamath, Palihapitiya, and others are always like 5%.
Yeah.
If you're a bit aggressive, put 10% of your assets into crypto or a risky asset class. But legislators and regulators are always going to go in on the quote unquote person that lost their shirt.
Yeah, exactly. And the reality is, investors in Celsius if assuming if they end up going into bankruptcy, then they are just going to be unsecured creditors, just like everybody else. This is not a bank account type product. This is not even. There's no protection whatsoever. So hopefully that doesn't happen. But
cautionary tale for retail and unsophisticated investors as well. Know what you're doing.
We'll continue to follow this story as it unfolds. But we're going to move away from crypto for a little bit here. First, we're going to talk about PayPal and buy now, pay later. PayPal, launched their Pay in 4 product back in 2020. It's been super popular. They have basically they've had like 22 million people use this product last year. That is a very large number. And but now they're launching basically PayPal Pay Monthly, which is that basically instead of the pay in full, which is just you pay 25%, 3 equal installments, usually every 2 weeks. This is up to 2 years, up to $10,000. Basically it's similar to what the place where Affirm plays, which is really just a term loan. They basically are offering term loans now, and that it's going to be popular, I'm guessing.
I mean, it's the natural evolution of buy now, pay later, which is as the transactions get larger, you need to come up with more options for the borrower to pay. Because not everyone's going to be able to pay, $2,000 off in 4 or 6 payments. Mm-hmm. Most people are also probably not going to want to do that. So I think credit is evolving away from just the credit card and just the term loan to all these different types of products, which to me is only good for the consumer. So long as there's a little bit of guardrails in place.
Mm-hmm. Yeah, I think it's cool to see credit evolve past, because this is like a credit card for larger purchases without having the card at all. I personally like having an account that I can like pay minimum on or pay off full price or see the balance of, than to trace down multiple, because I bet you PayPal isn't going to be the only person or only group to do this. But it's still cool to see how it evolves and changes.
Yep. Okay, staying with buy now, pay later, there was an article in Wall Street Journal by Telis Demos. He's been covering the fintech space for a long time. I think he spoke at one of our very first events. Anyway, he was talking about really looking at the buy now, pay later companies, their share price, and comparing with just traditional financial services. And it took put a lot of focus on Affirm. And Affirm, he said they're only 2 to 3% of Affirm's portfolio is in 30-day delinquency. That I was surprised by that number. That is a pretty low number considering they have a pretty wide credit box. So, and it's in line with where they were pre-pandemic. So he's just talking about like Affirm. He was looking at sort of maybe it's been oversold. I mean, that was sort of the premise. He wasn't providing investment advice, obviously, but that's sort of that's what you could read into what he was saying there, that Affirm's got some decent numbers and they have been hammered.
It's funny. I hearing you say that, Peter, a little bit of a shameless plug. When I interviewed, I think it was Mark Luber of Equifax.
Yep.
At USA, the session title was something like BNPL and consumers and data. And what they found was that the people using BNPL were not credit invisible or credit challenged. They were people that knew how to use credit. And for the most part, they might have high balances on credit cards, but they're savvy credit users. They know how to move stuff around. They know how to keep their scores in pretty good shape. And while they might not pay stuff off, they kind of know how to work the credit system. Yeah. And this goes to kind of play into the story here, which is 2 to 3% 30-day delinquency. On the face of it, would have seemed pretty low, but if you kind of combine those two things together, it makes a bit of sense.
Mm-hmm.
Yeah, it does seem like I saw that panel too. That your guys' talk. It does seem like it's people that are credit educated, I guess, that are using these products. I thought the article was interesting too because it talked about why buy now pay later in general is underperforming the S&P, which is saying something because the market's doing terribly anyway. But one of the aspects was the actual mechanics of how it works as a consumer credit product. Like if you miss a payment, you might get locked out completely of ever using the service again. And if I miss a payment, or if I make a minimum payment or something, my credit score might actually go up because traditional credit providers are pretty happy with you utilizing their credit at all, or even incurring more of a balance. And that's pretty interesting when you look at Klarna or anyone who has delinquency rates in buy now pay later.
Mm-hmm. Sure. Well, that is a big conversation that we will move on, I think, Kevin. We don't talk about prop tech much, real estate tech. We touch on it today because I like to celebrate little victories. Homelight, they're a prop tech company, been around for, I think it's been around for a while, like 10 years or so. And they announced they had raised another $60 million. They called it an up round. I mean, they called it actually an extension of their Series D from last September, but that was 9 months ago. Let's face it, it was a Series E, really, or a Series D2. But they went from a $1.6 billion valuation to a $1.7 billion valuation. I mean,
up is up.
That's up. I mean, and like, basically, if you can even do a flat round, flat is the new up, they say.
Yeah.
They have, and actually also when they made an acquisition too of one of these, cash offer places that let mortgage buyers do cash offers, and so there are some maybe the real estate market hasn't been hit as hard as some of the other places.
Real estate. We went into the pandemic. Everything kind of cratered that first month or two, and then all of a sudden it was this refi boom. I did one. I think, Peter, you did one. Many others did one. Mm-hmm. But then real estate in general has kind of just like flown well under the radar, especially with the success and newsworthiness of crypto and buy now, pay later. It feels like real estate has kind of just went. And some of the stories have been bad, like better.com, but it's also coupled with rates starting to rise. And that's obviously going to slow down the housing market because people don't think they can get a great offer on a home anymore. But I think we've had Homelight speak before, the iCash or, whatever that model is, certainly had a lot of
buying, they call it. Yes.
Yeah, had a lot of publicity there for a while, and then people were holding a ton of homes on their balance sheet that couldn't get rid of. But interesting round, and like you said, flat is the new up, at least for the time being.
Yeah, I was just gonna say, and when you're in the same market or niche as better.com, flat is definitely healthy.
Yeah, no, and I think I think real estate there's still a lot more room there's a lot more innovation that's going to continue into real estate. There's a lot of work left to be done, a lot of wood to chop, as our colleagues.
So many pieces of that transaction, from when you initially think of buying a home to when you get the keys, that are just still not to where they can be.
And it's better than it used to be, but we're
for sure.
I mean, I did my refinance with Better, like, I don't know, a year and a half ago, whatever, and it was a great experience. Loved it. Very, much better than it was, 10 years ago. But anyway, let's move on. The mayor of New York City, Eric Adams, who was our opening keynote at our USA event 3 weeks ago, he is in the news again. We're going back to crypto for a little bit. The New York legislature has passed, the lower and upper house have both passed. It has not been signed into law yet. But they have both passed a ban on new crypto mining projects in the state of New York. Now, Eric Adams, the mayor of New York City, is not a fan. He wants the governor to veto this bill, and I'm on his side. I think the reality is this mining is going to happen, and even at these prices, it's going to. I don't think there's going to be a slowdown in mining, but if it's not going to happen in New York State, I mean, it's going to happen somewhere. You may as well put it in a place where there is good environmental regulations. Do you want this going, to the third world countries or somewhere in Eastern Europe or something? So anyway, thoughts, guys?
Good luck dealing with the rat's nest that is the New York political class. I mean, I don't know. If you're going to be a leader in financial services, fintech, and tech, doing this does not put you as a leader. A leader is figuring out how mining works, and then is there ways to then reduce the environmental impact
Right.
Because if you can do those two things at the same time, you become an even bigger leader versus, oh, let's just stop it for a couple of years so we can figure it out. Like, to me, that's the short-sighted way about going things. But
Yeah, why don't they just say, you got to do 20% renewable power or something if you want to start a new crypto mining project. I think I would like that as a better argument. Anyway, any thoughts, Kevin?
Yeah, it's always strange to me when the line is drawn on renewables, as if because mining is going to be done no matter what, and whether it's done by burning carbon or turning like solar panel electricity into proof of work to turn electricity into validating coins and transactions. I don't see what the major difference is, because either way, that energy could have been used to heat my home or run the subway here in New York City. So how is it like being less wasted if it's like done through wind turbines?
Yeah, and the whole idea is to bring demand up for the renewables. That's my perspective. Now that we're getting out of the scope of a fintech discussion, but your point is taken, Kevin. So moving on, I was actually at the announcement where they made this. This was announced at Consensus last week. Abra, they have a crypto platform, crypto exchange. They're partnering with American Express. This is American Express's first foray into crypto rewards cards. Abra is the first one out of the gate. And this is interesting. Like the thing that's slightly different here is that you get your rewards in any one of 100 cryptos that are then able to be traded anywhere on the with any of the other available tokens on the Abra network. Tech is powered by I2C, which I thought was interesting. Not one of the other guys that we've seen. So it's a waiting list happening now. They hope to launch it later this year. But good to see American Express getting involved in this, I think.
I mean, I'm excited to see it. I expect almost any card offering or company or even buy now, pay later or something. Loyalty when it comes to crypto is going to be big in the next 2 years. And it's cool to see American Express jumping on it, because it seems like a fun way to get people involved in cryptocurrency and rewards and staking or whatever.
Okay, let's move on. We're going to talk about the crypto winter. This was an article in CoinDesk, which I thought was super interesting. Basically, the title is "The Crypto Winter is Here. The Weak will die, and the strong will eat their bones." And that was kind of the gives you a good flavor of the tone of the article. So basically, it's like I think this guy was a little annoyed at all of the worthless crypto projects that got funding in the last year or two, and he's saying that they will fail. It's going to be a big cleansing of the crypto system, which is going to be a great thing. There's still plenty of money available for good projects. So he basically is arguing that the crypto winter is going to be a real net positive for crypto long term.
I mean, I subscribe to that theory as well. For the short-term pain, you're going to find out the companies that really know what they're doing. That know how to navigate when funding isn't just knocking through their door at one phone call and a term sheet in 3 days and a round announced in 10. You're going to find out what technologies are really potentially long lasting, and you're also going to come up with new ideas. People that maybe were fired from Coinbase or somewhere else and said, you know what, I had this idea. Your Coinbase or whoever got a little bit too big. There's a bit bureaucracy there. Now let me work through my idea. Maybe I can get a little seed cash. I could bootstrap it, whatever. There's a lot that comes out of downturns that is very, very good. And usually you find the exceptional entrepreneur find their way through.
Mm-hmm.
I think in the article he talked a bit about, I definitely agree that winters and summers are very healthy for crypto and any new tech, especially one that moves as fast as this. In the article, he talked about the experience of being at Consensus event in Austin with the rest of the desk team, and how there was such a variety of people, companies, and ideas that were all there, from Gary Kasparov, the chess player, to SBF talking about, political things and not maybe crypto and fintech. I think the focusing is a good thing when it comes to winters crashing down and sort of reining in what really works in the industry and what really deserves like attention and spark.
Yep. And even like we were both there at Consensus last week, Kevin, and the mood was pretty positive. Now, this was before I think crypto's down like another 25% since we got, and that was, since we left, which was, 5 days ago. So it's still certainly not.
There is a slight difference, Peter, if you remember back in like, was it 2017 going to 2018 or 18 into 19, one of the two. There was a lot more skepticism around crypto generally back then.
Yep.
Now, you don't hear the same skepticism today about crypto as an idea, as a future. You might hear it about some of the crap that's in the system that needs to get flushed. Some of the algorithmic stablecoin stuff, the Celsius of the world, maybe, that are doing things that maybe are around the edges or not completely above board. Not trying to call out Celsius or others, but you don't hear the same skepticism generally in the market. And so I think we've certainly reached a different point of the crypto evolution. And I think we realize that it's not a revolution, but an evolution. And it's going to go through ups and downs. And I think eventually we'll see it widely adopted in some form or another. But I think that's at least something positive to take away from this as well.
Yep. There aren't as many naysayers this time that's saying that the whole thing's worthless. Although Bill Gates did say that this week in an article, but what does he know? Anyway, wrapping up with our last story is from the European Central Bank. One of the board members there, Fabio Panetta, talked about the digital euro. And this was really interesting. He's basically saying, yep, they're doing a digital euro. It's going to launch, he thinks, within 4 years. And this is a board member saying this. And the thing that I haven't heard before, which was most interesting, he said he thinks it's going to be capped. Like the total circulation of the digital euro will be capped at 1.5 trillion euros. So what that means is, I don't know what the exact GDP of Europe is, but it's in the tens of trillions, probably, I'm guessing in the high tens of trillions, maybe even 100 trillion as far as GDP. So you're talking about a relatively small amount. And I'd actually like, this is basically, he said, between 3,000 and 4,000 euros per person. Because that's what you can maybe have it as your like spend account, throw some money in there that you're just transacting back and forth, but it's not going to be sort of the core of your financial life. And that could be a way to kind of get banks on board and not have everyone just close their account at the bank and go have an account directly at the central bank. So I thought that was an interesting piece.
Kind of the Web 2.5 world. It's like the in-between. Not going all the way, but beginning to adopt it in a way that we start seeing the benefits, but we don't go from this world to that world in the blink of an eye.
Yeah, it's interesting that there is that limit. I know, Peter, during your panel with, among others, the CEO of Figure, Mike Cagney, who helped the USDF consortium, I think. There's a group of community banks that have their own stablecoin. Theirs is like unlimited. It's
right. Well, that's going to be issued. They want theirs to be issued by banks. So the banks are issuing stable coins. This is, this is going to be sort of what Cagney thinks is this is the de facto CBDC. We don't need a CBDC because we're going to have banks issuing digital currency. What the euro is saying is that we're gonna issue our own, and it's just going. And this makes perfect sense to me. This is going to be like it's not quite what you said, Todd, because it is going to be. They're going all in. They're just going all in a little. So they're not sort of doing a. They're not sort of betting the whole economy on it, but they're. I think it's good because maybe in a decade's time it'll be 15 trillion euros as they get used to how things work. But it's good to start with a small amount that's not going to crush the banks. It's not going to crush the economy if it all blows up. Anyway, we are out of time. Thank you very much, Todd and Kevin. Thank you for watching or listening. The audience appreciate that. I'm going to be off next week. I'm heading into the Colorado backcountry to do a backpacking trip. Todd will be taking the reins, and
we have our guest already, which is Kim Gerhardt of FinTech Interactive and Kabir Kumar of Flourish Ventures. So make sure you tune in next week. It'll be a great show.
Okay, great. Well, thanks everybody, and we'll see you next time.